My name is Nils Olav Furre Thommesen. I'm the Deputy Head of Research at Fearnley Securities. So in the Astrup Fearnley group, we have an extensive research covering of the shipping markets. We have physical market analysts where I and my colleagues incorporate their works into equity and credit research. And it's good to see all of you here today. And today we'll do a run-through of an overview of the shipping markets. And I think it's fair to say that last year, when we were here, there were a lot of uncertainties. We were a couple of weeks ahead of the US election where Donald Trump was predicted to win, and his talks about tariffs would, all else equal, be a net negative for trade and therefore shipping. But I think it's fair to say that this year, the uncertainties are even larger, and there are more uncertainties in the market. We still have the conflict in Russia and Ukraine that has been supporting the product tanker market, also been a headwind for the LNG carriers. And the narrative changes there every week, whether Putin and Trump will be able to negotiate a ceasefire. You also have the closure of the Suez Canal for most of commercial shipping. That's still in place. We now have a ceasefire between Israel and Hamas, but we don't know how long that will last, if it will last. And even if that is the start of a lasting peace agreement, it will take time before Red Sea transits normalize. Then we've had the introduction of US and suddenly also Chinese port fees. When both of these frameworks were introduced, from a first take, they would have a meaningful impact on the various shipping markets. Then they've been moderated, so they're more palatable to manage. But I think still that this will create some inefficiencies that, if you are well positioned, you can capitalize on. We still don't know how the US and China trade deal will look or how that will be concluded. Obviously, we have meetings coming up over the next weeks that will be important, and how the trade agreements between these two countries end up will be a significant driver for the market developments for some of the segments that we're going to talk about today. And then lastly, last week, quite surprisingly, IMO announced that they were postponing the decision to implement a net zero framework by 1 year. But I think that we can all agree that this postponement is also a signal that unless the framework that was presented is changed, then the US will not be part of that. And the US is obviously a key contributor to global trade, and thus finding a solution that they agree upon will be important. And I think it's also fair to say that as long as the current US administration is in place, the outlook for a net zero agreement it's difficult to see that being concluded over the next years. But overall, these inefficiencies have been very good on shipping. And what this graph shows you is that for every square that is represented, the vessel class that is listed with the color on the bottom of the graph is making earnings above cash break even. So you can see after abysmal end to the 2010s, we've had a combined rally for all shipping segments. And the white dot represents the average earnings above cash break even. And that peaked in 22 due to the container boom, but we still have very strong earnings across most shipping segments. And that has led to a growing order book. As we know in shipping, when cash flow is there, owners are looking to renew their fleets, and this time around it's no different. So 2025 will be an all-time high in terms of new build deliveries. But we see that the strong markets that we've had has also, shows that we will have a new all-time high in 2027. And this, the past 12 months, we've had containers being the largest driver contributing to the growth in the order book. But we also see that there is sizable tanker orders that have been made and also within LNG. And I think also on LNG, we expect more ordering to come. And in general, there is a need to renew the shipping fleet, because what the graph on the left hand shows is that despite the record high amount of new build deliveries, the shipping fleet is still aging. This is largely driven also by tankers and bulkers. And right now, the yards have a very comfortable position. Their forward coverage is strong. They have good visibility on their projects ahead. And therefore, newbuilding prices are also staying elevated, even though average shipping earnings has come down a bit since last time around when we were here. But that also contributes to stronger second-hand prices. So that trend, it's difficult to see that changing unless we have a market that deteriorate meaningfully. And I think it's fair to say across most segments we see a lot of in demand for modern tonnage, whereas a lot of buyers are looking for the same vessels, and that's keeping asset prices at strong levels. And moving into the various segments, starting off with tankers, we believe that oil demand is set to continue to grow for the next 5 years at least, and that's obviously a good backdrop for the tanker segment. And what we see is that most of the oil demand is coming east of Suez. That's developing countries in Asia that is driving that demand, and that in the Atlantic basin we will have a reduction in demand from Europe and the US, partly offset by Africa and South America, but that will lead to a lot of volumes being moved from the Atlantic and into the east. We also see that closures of refineries in the west and increasing refinery capacity in the Middle East and in Asia will also be a positive driver for ton miles for the product tankers. And you also have an aging fleet in the tanker segment. I think it's fair to say that if you look or think about the graph we had on the order book, if you're looking to make a sizable order these days, you have to look to 2028. And if you look at this graph in the middle, it shows you the age composition of the fleet when we get into the next years. So in 2028, almost 30% of the tanker fleet will be above the age of 20. Historically, tankers have been scrapped around 22, 23 years old. So there's a massive replacement need for the tanker fleet if you believe that oil demand is going to continue to grow. And there's another facet that can act as a catalyst in the phase-out of older tankers, because a lot of these older vessels are now deployed in the shadow trade, carrying sanctioned barrels. And if we see sanctions being lifted, that will be a massive positive for the tanker segment. Right now, we're in an oversupplied oil market. That is leading to very high utilization for the crude carriers. So we think crude carriers will continue to be very strong for the foreseeable months and into 2026. Whereas product tankers, you have a larger order book being delivered in 2026. So we think that historically, rates will remain quite strong, but that we will see an average slightly below where we have been throughout 2025. On the dry bulk side, the visibility on supply is very good. The order book is around 10% overall, a bit lower for Capes and Newcastle Maxes, and a bit higher for mid-sized bulkers. But overall, we have very good visibility within this segment because newbuilding prices are still elevated and yards are prioritizing higher margin ships to build. What we see over the next years is that the macro headwinds are quite solid. And what we want to show you in the graph in the middle here, which is a bit of a complicated one, so I'll take time to explain it, is that the level of the US dollar has a big impact on the dry bulk markets. So the dark line shows you the inverted performance of the US dollar index. And as you can see from the start of 2025 until now, the US dollar has depreciated by around about 10%. And with most commodities being quoted in dollars, and commodity prices are in general down or flattish, then these commodities become cheaper. That incentivizes demand, both from consumption and inventory building. And we see that historically, the strength of the US dollar has a negative correlation with dry bulk shipment volume growth. So we think that volume growth for dry bulk will be there over the next months. And we also have new projects on the iron ore side, particularly Simandou in Western Africa, that will come with new iron ore volumes, which we believe that there are takers for, particularly in China, which will be a big boost for ton miles. So we think into next year, there is a good outlook for the dry bulk segment. And also for dry bulk, in a couple of years down the line, there is a massive need to replace this fleet. And the graph on the right hand shows you that between 2010 and 2012, almost a third of the dry bulk fleet was built. Those vessels will be 20 years in not too long. And as we know, dry bulk vessels tend to be replaced when they get above the age of 20. So, for both bulkers and tankers, there is a big replacement need, and that will obviously be addressed at some point. But again, the postponement of the IMO's decision to postpone the net zero framework, that is only going to create more uncertainties and keep a lid on speculative newbuilding activity, which again then supports the markets over the coming years. On containers, we have seen that freight rates, which you see on the left-hand side of the screen, they have normalized after the massive diversions you got after the Suez Canal closed at the end of 2023. So 24 was a very good year, and 25 has also been quite solid for the container liner companies, but we're now seeing freight rates coming down to levels close to where they were in 2023. But despite this, charter rates are holding up very well, as you can see on the graph in the middle. This shows you the graphs for some of the feeder-sized vessels, but this also holds for the larger container vessels. And why are charter rates holding up when freight rates are low? Well, there simply isn't a lot of ships available. The Red Sea is still absorbing 10 to 12% more ton miles compared to what would be the case if the Red Sea was open. And you also have had big liner companies flushed with cash like CMA and MSC being quite aggressive buyers of second-hand tonnage. So the share of the tonnage providers' fleet in the container segment has come down. And that has led to less vessels being available for smaller liner companies. So there is, to some extent, also a fear of missing out. So even though we believe that the container market will come down on the rate side, there's still a very good window of opportunity for the tonnage providers to increase their very strong backlogs and strong balance sheets. But the reason why we think rates will come down is that the order book has grown a lot in the container segment. So right now, the order book to fleet is above 30%, and that is even after the fleet has grown by more than 20% since the start of 2023. But it's important to also remember that if you look at the larger vessels, you have an order book to fleet above 50%, and then for the smaller vessels, we're talking about an order book to fleet of less than 10%. So I think over the next years, it's fair to say that, for example, feeders will outperform the larger sister vessels, simply because the order book here is also quite limited, and there is a replacement potential with those vessels also being older on average. On LNG, there's very different outlooks for the short and for the long term. So short term, we have an oversupply, which has been caused by LNG liquefaction projects being delayed, whereas the vessels have come on time. We've seen that in previous cycles, and this is no different. And we will have elevated fleet growth also in 26 and 27. So even though the volume growth will improve, it will take some time to absorb this overcapacity. But then, come 2028, we think that the market will be in balance. And then come 2030, because we've had a lot of new FID projects in the US, or projects being FID'd in the US over the past 12 months, on paper, this market is undersupplied in the long term. So we think that you should expect rates to be under pressure for the coming 2 years, but then things are certainly looking much better as we enter the latter part of the decade. And this, capacity adjustment or the market balancing out will also play, or a big factor will be at what point the steam turbine fleet will be replaced. We're seeing now that layups of steam turbines are increasing sharply, and we are seeing record amount of scrapping. So we think that that will continue to occur over the next years, and then the market balances out a couple of years down the line. On LNG demand, we are very positive that that will pick up once we see increased volumes And also potentially, if the conflict in Ukraine is resolved, we think that LNG will be a very attractively priced molecule, especially with the backdrop of a lot of energy demand coming with the wave of AI and the infrastructure required there. LNG certainly has a big place in the energy mix over the next decades. Then on the LPG market, the volume outlook is quite strong. So the left-hand graph, that shows you the production out of the US. And as you can see, for 2025, we've set new records almost every single week. And that has led to an increase in exports out of the US, which is natural because US demand doesn't really grow. So the incremental production is going to exports. And LPG is a supply-driven market. So if volumes are there, then prices usually tend to come at a level where volumes are cleared. And we also have massive investments in infrastructure in the US to accommodate for growth for the next years. So what the graph in the middle shows is that the bars with the solid colors, that is export terminals with sole LPG capacity. And then the more shaded area is if they have flex capacity, they can do ethane and LPG. So if we look at solely the LPG export capacity, it's set to grow by almost 40% by 2028. And if you include the flex capacity, we're talking about an increase of over 60%. So that will not be a bottleneck over the next years. What is sort of keeping a lid on the enthusiasm in the LPG sector, or the VLGC sector, is the order book. So as you can see on the right-hand graph, deliveries will start to pick up at the end of 2026 and remain quite elevated throughout the first half of 2028. So we do think that in 27 and 28, we will probably have some softer markets than what we are seeing now. But it's important to remember that the order book that is coming is needed for the growth we are going to see of LPG over the next years. And let's not forget about the Middle East in this picture. We talked about US growth being big, but we have the Qatari LNG projects coming on stream in the Middle East next year, and that will also lead to an increase in exports. So again, the volume outlook for LPG is very good, and then it's just about absorbing that capacity that is set to hit in 2 years' time. Lastly, the PCTC market. We've had a correction in rates, as you can see on the left-hand side, but that's natural. We came from all-time high levels, almost fantasy numbers. We've had 10% fleet growth this year. Still some fleet growth left for the coming years, but I would say the capacity that has been coming has been absorbed in quite a healthy manner. What we see on the market side is that car sales, they are still growing, albeit the growth rate is coming down. But China is still growing their exports, and that's quite a ton-mile intensive journey. So that has been the positive driver for the PCTC market over the past 12 months. Now, will car sales continue to grow? I think so, unless we have a correction in the world economy. And then the question is just by how much. So we think that China is certainly there to meet the demand for new vehicles. But you also have to keep in mind that we are seeing a picture where tariffs are being implemented. For instance, Mexico have implemented a 40% tariff on Chinese vehicles, and Mexico is a big market for China. So if you continue to see a protectionistic direction where tariffs are introduced on Chinese vehicles, then that would probably lead to overcapacity in the PCTC segment. But so far, so good. We expect rates to gradually soften over the next years, but I would rather say that the market balance looks quite fair. So, over the next years, will we see choppy waters or is it smooth sailing? It's, a lot of this depends on the geopolitics and what is the outcome there. So I think, pay attention. Ask your Fearnley broker about how this is going to impact the markets. We will be there to support you. Fundamentally, there is mixed outlooks for various segments, mainly due to the supply that is coming in, but we still expect strong shipping markets, at least from a historical perspective, to continue, and that there will always be interesting opportunities to capitalize on over the coming years as well. So with that, I would like to thank you for your attention.